guys, we have to prepare. There's going to be a slowdown here. And he's doing that to kind of cushion the actual event so people aren't shocked when it actually comes. But it's coming, folks. I mean, it is coming. The fact that Jerome Powell, a couple months ago said he didn't see a recession, that's like the kiss of death right there. You definitely have a situation where Ben Bernanke did that in 2008, and look at what happened in 2008 and 2009. But again, the data out there is showing us that the economy is absolutely slowing. Believe it or not, it wasn't the greatest of jobs numbers. And I know the headline number made everyone say, wow, that's an amazing growth of jobs, 336,000. But if you actually go under the belly of it, it's kind of like looking at a car and saying, wow, that's a great car. And then you look under the hood and you're like, oh, this is a lemon. The same thing with this jobs report. And what I mean by that is that full-time workers actually declined while part-time had a major gain. And in fact, if you look at the last 3 months, full-time jobs gains are actually a loss. It's down about 600 and change thousand in full-time work. And what does that tell us, right? So it tells us that the underlying economy is starting to weaken. More part-time work is being taken on because they can't find full-time jobs. Then throw into that President Biden, I believe, had a press conference around 11 a.m. on Friday when the jobs number came out. And he actually said, expect to see weakness in the jobs market. So he's basically telling you what is coming. The numbers in the underbelly confirm that. And we saw the yields after initially popping on that jobs report, and the dollar as well. We saw the yields coming back in and the dollar actually turning negative. So the market loves a lower yield and a lower dollar. I think at least from a government point of view, it becomes very political, and where, you don't want this to surprise people. And all of a sudden going into next year's elections, the unemployment rate starts to spike and people are losing their jobs. So what he's trying to do is he's saying, hey, listen, it's been a great run, but guys, we have to prepare. There's going to be a slowdown here. And he's doing that to kind of cushion the actual event so people aren't shocked when it actually comes. But it's coming, folks. I mean, it is coming. The fact that Jerome Powell, a couple months ago said he didn't see a recession, that's like the kiss of death right there. You definitely have a situation where Ben Bernanke did that in 2008, and look at what happened in 2008 and 2009. But again, the data out there is showing us that the economy is absolutely slowing. Actually, you have to dive in a little bit deeper to full-time and part-time. So a lot of the healthcare jobs are part-time jobs as well. And so you have to go into that. But I think just the fact that the government is adding jobs, this also skews things, right? The government basically has a free paycheck at this point to add as much as they want. We've seen the U.S. deficit or the debt go up sky high, adding something like $500+ billion in a couple of weeks. We're now at 33.5 trillion. Now you throw in interest rates where they are, and ultimately this is putting us on a crazy crash scenario down the line in terms of how much debt we are taking on, and obviously the interest that we're paying. So you go to the jobs data, it is showing us weakness. We see the government doing most of the hiring. That's never a healthy thing. You want to see the private sector doing most of the hiring, and then throw in the fact that debt is soaring. That is not a good recipe. So it's all going to come down to how fast the economy declines, right? So the Federal Reserve has made it very clear they're okay with a slowdown, a recession, in fact. But the question is, if it gets really dramatic, if we see a fall off a cliff type scenario where the stock market declines 20% in a month or two, where does the Fed step in? Now, they have raised interest rates to a point where they could cut a little bit. I talked about this earlier today, like a mercy cut, where they can't lower interest rates as much as they might want to because of inflation still being relatively elevated, but they could do something to just reassure the markets that they're willing to act. But when all is said and done, the Fed has a handcuffs on, and it's going to make it very tough for this economy. When we slip into a recession, we're not going to come out of it very quickly. And I've said this for a while, we're looking at a scenario where we could be in a recession for years, in fact, even if it's not a horrendous, nasty depression. The bond market is generally better. It's a bigger market, more money involved in the bond market. You're talking something like 50 trillion in the U.S. in the bond market alone. I think about 150 trillion globally in the bond market. So it is a bigger market. It's known as the smarter market, and I agree 100%. And speaking of which, take a look at this chart of the yields, the 10-year yields, and look at what we've seen. So I have a trend line that goes back to 2012 here, and it's really a beauty. And what we could see is every time we hit this line, there's a pullback, right? Pullback. Well, look at what we just did. We just pierced the line, and the yields are beginning to pull back as well. And so what this tells me is the bond market, even in spite of a strong jobs number where everyone was saying, wow, this is so strong, the bond market is actually sniffing it out and beginning to see a decline here in yields. And that, again, is a heads up. bonds themselves, right? Bonds have been cut. I mean, this is the other crazy thing. These banks out there, right? You're talking about all these banks, these regional banks, they have billions, hundreds of billions of dollars of these bonds on their balance sheets that are not marked to market. So they can keep them on there, but we have to remember that a lot of these bonds are down 25 to 50%. So I think the bonds, I would expect bonds to rally as yields pull back. But I think the pullback in yields that we're seeing here on the chart is clearly telling us that the market is anticipating, the bond market is anticipating an economic slowdown, which would then kind of cap interest rates and maybe even start to bring them in just a little bit. Well, my guess is we're not going to hear the announcement on CNBC or anywhere like, hey, guys, we're going to now have a recession. It's something that's going to naturally happen, right? But you're 100% right that the yield curve inversion is where everyone freaks out, and then everyone kind of becomes complacent. We saw this in 07, 08, right? Same thing. Ben Bernanke coming out saying, hey, we're not going to have a recession. We're not pricing that in. We saw that same thing with Jerome Powell a few months ago. But ultimately, it's the uninversion that is the trigger, or at least that coincides with the recession, and it is now quickly approaching. And you kind of throw together all of these economic numbers, the jobs numbers I just discussed about part-time versus full-time, and these other factors, and you could start to make sense of why we are likely in early 2024 to enter a recession. The question is, what's the stock market going to do, right? So right now, if yields pull back, the market actually wants that. And so we could get a short-term rally in the S&P and in the NASDAQ, but ultimately at some point, if we slip into recession, the economy really takes a hit, earnings are going to take a hit, and the stocks are going to really take a tumble as well. The thought process is this, is that if you go back to really 2009, every time the economy has even tripped, not even stumbled or fallen, but just tripped, the Federal Reserve has come out gangbusters with liquidity into the system. And that's always been okay because inflation has been essentially below 2%. Well, we're at a point now where inflation is elevated. We're seeing strikes all over the country, healthcare workers, UAW workers, all these workers striking. They're getting higher wages. That is also inflationary. So again, it's going to be one of these scenarios where, like I've said, and we've had this discussion for 6+ months, inflation is likely going to stay at 3% or above for the foreseeable future, which is going to make the Fed's job for cutting when they come to rescue the markets almost impossible. Can they cut? Yes, maybe once, maybe twice, throw a mercy cut out there, but they can't really take us back down to jerk us out of this recession. And I think that's the big issue here, is why it could last a lot longer. If you don't have the Fed intervening like they usually do, which is a gangbusters intervention, then recession may be in a store for a longer period than usual. And we're seeing like personal debt, right? Credit card debt over $1 trillion, new all-time highs. We're seeing bankruptcy filings hitting new records as well. And I mean, there's so many of these underlying signals, even with the consumer still willing to spend and run up debt. But there's so many of these underlying signals that are telling us that people are really starting to struggle. In fact, I would argue that a good chunk of the population in the U.S. already thinks or feels that they're in a recession. It's just the people that haven't had investments. If you've been in the stock market since last October, you're feeling pretty good. And I think that's kept consumer spending up. We've now seen a top out in that phase of the markets, and we're now starting to curl over. And if that continues, you'll see the recession feeling hit the whole majority of the U.S. You could be talking about, having to pay student loans again. That's a tax, essentially. You could be talking about just having interest rates be higher. I mean, how do people go out and buy a home right now? You look at where rates are and what the mortgage payment is on that same $500,000 house from 5 years ago to right now. It is insanely different. Inflation, right? Inflation is a tax. And so people are being taxed over and over again. Now, if you had stock market investments and you were riding them up all the way till, the last month or two, you were probably offsetting that effect. But a whole portion of the population isn't able to offset that. And that's the population that's been feeling it already. Now you're probably going to go into the second phase, which is the stock market stops going up, which means everyone else starts to feel it as well.